Financial Mappers is designed to let you complete detailed planning of income streams in retirement. For each liquid type asset, you can nominate the year in which you wish to commence a drawdown and over how many years you wish to allow that asset to last. These assets are cash, shares and managed funds. With the superannuation account and the self-managed superannuation fund, there are three methods which will commence at the nominated age. These are the number of years, percentage of funds over 2 time periods and a specified dollar value. In addition, the superannuation account can be converted to an annuity at the start of drawdown. Where the fund exceeds the transfer balance cap, the drawdown of the excess accumulation funds is nominated as a separate drawdown value. Where there are insufficient funds to service the nominated retirement income, real estate may be sold and the funds reallocated to suitable investments. For demonstration purposes, screenshots will be from a 30-year retirement plan for a single person with investments of $1.2 million in superannuation and $1.2 million in assets held in other investments. Note that the default rates in this exercise are the average returns for 18 years from the year 2000. These have since been updated to the 20-year average from the year 2000. John Citizen is age 65 and wants a retirement income of $120,000 for the first 10 years, reducing the amount by $10,000 each additional 10-year period. He owns his own home and has no debts. Each asset will be discussed and why a particular drawdown has been selected. For this exercise, all the interest-earning assets will be kept in the transaction account with the exception of $50,000 for emergencies, which will not be accessed in the planned drawdown. In the retirement phase, drawdown from accounts is deposited into the transaction account at the start of the year. In the first 5 years of the plan, the funds from the share account and the superannuation are being drawn down. The withdrawal at the start of the year is the amount nominated in the retirement income. These funds are withdrawn and deposited into the budget as personal income, replacing salaries from the savings phase. Note how the value is allocated to retirement accounts, investment income and investment capital. This gives you the opportunity to think about how much capital you are spending and how this may impact on your cash flows. Some people may be resistant to spending their capital, while others may not see the dangers of spending capital too quickly in the early stages of retirement. Note that the program automatically splits the tax on all income between the transaction account for investments and the budget for personal income. During the retirement phase, the nominated retirement income will be treated as personal income. Having some extra funds tucked away for an unexpected cost, such as a major health issue, can be facilitated by placing these funds in a separate account. In this case, the income is reinvested and there is no allocation to the drawdown. In this example, the cash account has been used, but you could use a managed fund if you wanted to benefit from some capital growth. Using the tab Asset Allocation, you could find a fund which best suits your needs. Here is an example of a conservative fund. In the share account, the balance is $200,000. The dividends will be paid directly to the transaction account. It is anticipated that 70% of the fund will receive tax imputation credits. The plan also has $200,000 held in a high-growth managed fund. The strategy is to draw down the funds in the share portfolio over the first 15 years. As the funds are likely to be self-directed investment, it may be you do not want to have such a responsibility after age 80. In this plan, the user from age 80 is going to draw down the funds in their managed fund account. The High Growth Managed Fund has a balance of $200,000 with tax imputation credits of 30% of the income. The default high growth entries will be maintained, but you can overwrite these values to match any of your recommended products. In this example, the investment return of 5% income and 7% capital growth, a total of 12%, has been nominated. It is planned to reinvest the dividends until year 16, when the commencement of the drawdown will commence. The drawdown period is for 25 years, meaning there should be a considerable balance for an inheritance, even if the client lifespan is well into their 90s. At the end of the 30-year plan, the client is aged 95 and should have about $390,000 present value in the account. There may be value in extending the length of the plan to 50 years to see the results for an extended drawdown period. Note that as you expand and contract the plan length, any entries made in the hidden section are retained for future use. It is just a matter of going to Plan Details page and change the length of the plan. In the plan, you can quickly scroll your mouse over the graphs to view the results year by year. The review chevron is also an excellent place to carry out this type of review quickly. Using the information icon, details for each dial can be accessed. If you have purchased an annuity or converted your super to an annuity, there is no resale value. Therefore, a dollar value is displayed as zero. To compensate for this, a line graph will display the value of the income from the annuity each year. Here is a graph of a superannuation account which is being converted to an annuity. In this plan, the user has one investment property which at this point in time no plans have been made to sell the property. The client may wish to retain the property as part of his inheritance or avoid paying capital gains tax. The option of selling the property and its implications will be considered later. The property has no debt and the default investment returns will be used. The following building write-off and depreciation has been added to the plan. No plans for building renovations or future capital purchases have been entered. However, this is something you may like to include. Often property owners forget about long-term maintenance fees, particularly where older buildings are owned. Check to see if your property will require a major renovation in the future. The net rental income is transferred to the transaction account, where this income can be used as part of your retirement income drawdown. This superannuation account has a balance of $1.2 million, all of which are employer contributions. The fund is maintained as a balanced fund, earning 7% with management fees of 1%. The drawdown has been nominated as 35 years, meaning the funds will expire when the person is aged 100. The investment profile, asset allocation and the risk profile, percentage of growth assets, are all displayed for you. Here you may like to consider if you should change the percentage of growth assets over the length of the plan. Generally, growth assets are considered a higher risk investment than defensive assets. Your financial advisor can advise you on levels of risk which would suit your investment preferences. Given the length of plans, having quick access to the expected drawdown in present value allows you to consider whether or not the retirement drawdown will meet your financial requirements. Where there is a gap in the actual result and your expectations, you can consider alternative strategies. If you have a need for one-off payments, these can be included with any of the three methods of drawdown. To simplify the process, you may prefer to see dollar values rather than a time period or a percentage of funds drawdown. A table of drawdown can be quickly created, and you can toggle between the three methods of drawdown to demonstrate the effect to different options. In this example, the user has decided to purchase a new car in 10 years at the cost of $40,000, and the funds are being withdrawn from the superannuation account. In this example, there is no provision for selling the home. However, you may want to consider the value of downsizing and putting some extra funds to work, earning you income. If you are reluctant to leave the family home, you could consider a renovation where part of the home is isolated and used for supplementary income, such as a granny flat. This also gives you the option of later moving into the granny flat yourself and increasing the rental potential. Alternatively, a family member may move back to mind their elderly parent. These are things you can consider in your plan. The retirement income is accessed on the planner page, and this is where you can structure your retirement plan using a layered income stream. The user would like the following retirement income. Note that in the third and last period we have extended the time so that if the plan is increased from a 30-year plan to a 50-year plan, the drawdown for that period will be available. Of course, you can make a new time period if you think you will require fewer funds. In the retirement plan, you can elect to use either present or future values. For this exercise, present values will be used. On the top graph, the income streams are divided into retirement account drawdown, investment income and investment capital. In this section, the graph displays the funds which have been used to create the retirement income. Note how the shares have been allocated for the first 15 years and the managed funds for the last 15 years as previously discussed. In the data view, you can click on the link and view the time periods for the drawdown. You can also activate the drawdown, say for emergency funds, or you can change the time parameters. This saves you going back to the account to make adjustments as required. You may recall that the user wanted an additional $40,000 to be withdrawn from the superannuation account, but no allocation has been made in the retirement income. Now you could change the table of drawdown allocation to include the additional $40,000. There is also another option. You can keep the original drawdown of the 3 time periods and deduct the $40,000 in years 10 and 20 in the transaction account. Any funds not drawn down in this plan will remain in the transaction account. The money has already been deposited into the transaction account and is ready for transfer to the budget for purchase of the car replacements. The net rental income is deposited into the transaction account and will be used as part of the retirement income allocated in the budget. However, if you find this rental income together with the nominated retirement drawdown is not sufficient, real estate may need to be sold. The options would be to downsize the home and release funds or sell the investment property. Selling the investment property may trigger an adverse capital gains tax liability, so timing of this sale, if applicable, should be considered. This is something you may like to discuss with your financial advisor or accountant. To assist you, a graph of real estate, both home and investment properties, is listed so you can quickly see which is the most likely asset you should consider selling. Do you downsize the home with no capital gains tax or sell the rental property? With financial mappers you can immediately see the outcome of these two options. Also note there is a graph at the top showing the balance of the transaction account, and this will let you know that you have sufficient funds for your drawdown. You also have a graph showing the combined value of net investments, retirement accounts and investment liabilities. At the bottom of the page, a graph is displayed for any pensions from external sources. In this plan, there are no pensions due to this being a high net worth person. The funds from either means tested or non-means tested pension are not part of the retirement income, and these funds, where applicable, are deposited directly into the budget. When the means tested pension is activated, it will automatically calculate when you meet the requirements to receive a full or part pension. Modern theories of plan construction are increasingly paying more attention to asset allocation and risk profiling. With financial mappers you can quickly assess all this information on the Chevron reports, plan outcomes. From these graphs you can quickly see what needs adjusting. All these graphs are telling you that the defensive assets are quite low in the midsection of the plan. Now you may be comfortable with this because much of that is related to the investment property. There are some options if you want to reduce the percentage of growth assets, and I think this is worthwhile considering some of those options. The options to be considered are downsizing the home and purchasing a bond trust with additional funds released for investing, selling a portion of the high growth managed fund and purchasing a bond trust, selling the investment property and allocating the funds to a property trust to maintain some exposure to real estate, a bond trust to increase the percentage of defensive assets. Let's look at some of these ideas. On the plan outcomes data view, you will find the value of the assets at the end of the year in present or future value. The value of the home at the end of year 8 will be $1 million present value. The user will be age 73. For the purpose of this exercise, the home will be sold with Home 2 purchased for $700,000 and $300,000 will be reinvested in a bond trust. Follow these steps. Sell the Home 1, buy Home 2 and purchase bond trust. The asset allocation will be as follows. The investment return is 6% income and 2% capital growth, and all dividends are reinvested. There is no drawdown from this fund. The injection of 300,000 defensive assets has reduced the percentage of growth assets from year 9. Another option would be to sell 50% of the high growth managed funds and buy a bond trust with the funds. At the end of year 8, the value of the high growth fund is estimated to be 378,000 present value. 50% of the funds will be sold at the end of year 8, and at the start of year 9, 150,000 present value will be used to purchase a bond trust. Using the same parameters as the previous example, funds will be kept aside for capital gains tax. The same drawdown is maintained as that of the high growth managed funds. The injection of 150,000 defensive assets has reduced the percentage of growth assets from year 9. Here's a note on the transaction account balance. As you commence looking at different strategies, you need to be mindful of the transaction account balance. A graph of the account balance is displayed on the retirement income page, but at the top of the plan outcomes page there are a set of 4 graphs called the 4 key indicator graphs. These graphs are your salary, investment plan, drawdown funding and the transaction account balance. In the retirement plan, only the last 2 are relevant. The graphs will quickly show if you have missed something or the transaction account is overdrawn. As you can see in this graph, the balance is just below the horizontal axis briefly for 1 year. These graphs are also found on the Chevron review. Triggering a capital gains tax liability is always something you should monitor, trying to find the most opportune time. Note the capital gains tax in year 8. Another option may be to sell the investment property to purchase a property trust and bond trust. You could sell the investment property in year 8. At the end of year 8, the value of the investment property is around 750,000 in present value. The capital gains tax in year 8 will be 92,000 future value, of which a small portion will be due to the sale of shares for the drawdown. These large capital gains tax liabilities could be one of the reasons you prefer not to sell real estate if there are other options. 2 managed funds are created, where all the dividends are paid into the transaction account as would have been with the rental income. The first is a property trust. 390,000 present value is invested in a property trust. The investment return is 5% income and 7% capital growth. 200,000 present value is invested in a bond trust with an investment return of 6% income and 2% capital growth. Asset allocation is displayed for both the value of the assets and the income. The reason is that annuities have no dollar value and no allocation in the asset allocation value. This is a graph of the investment profile, asset allocation and risk profile. Financial Mappers is designed to be educational and fun to use. Sometimes it's not about creating very complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions you make. We like to think you can use Financial Mappers as a doodle pad where you can look at very simple concepts and then try to understand what is likely to make the outcome better or worse for you.